Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. Markets are increasingly being driven by headlines, but are investors focusing on the wrong things? This episode explores the structural forces shaping the global economy and why looking beyond the obvious could uncover unlocked investment opportunities.
I'm Stacey West, and today I've been joined by Alec Cutler, manager of the elite-rated Orbis Global Balanced and Cautious Balanced Funds. Alec, thank you very much for joining me.
Thanks for having me.
So I wanted to start with something that we had touched on last time we spoke, which is now probably about 18 months ago. It was just after the elections when Trump came back into office. And at the time, we had talked quite a lot about what this might mean for markets. So we talked about tariffs, currency, trade shifts, and where opportunities might come off the back of that. But I want to fast forward to today, because a lot of investors seem to kind of look at Trump and politics and the ongoing geopolitics. And this has been the main driver of what's been happening in markets. It's what everyone seems to want to talk about, which is ironic because it's where I'm starting today. But you've tended to frame it a little bit differently in that it's more of a symptom of a deeper structural change that was kind of already happening. It's not really Trump's fault, let's say.
Yep.
And so what do you think was already shifting beneath the surface? And then why has Trump become this focal point? And how are we today?
There's a couple ways we can look at this. Trump is a manifestation of populism being on the rise. Why is populism on the rise? Populism is on the rise because people don't feel good about the environment they're in. They don't feel good about the deal they've been given by their government, and they want to change. And we're seeing it in other countries as well. So that's one aspect of it. That's part of what drives Trump on a daily basis. The other is that we had it good for too long. The Western world, the developed world, had it good too long. From the fall of the Berlin Wall, we had peace. From the peak in interest rates in the early 80s, we've had an ever-dropping interest rate, which produces a wonderful tailwind. We had goods that were ever cheaper as we outsourced around the world and embraced globalism. All of those things have been reversing, ending, crashing, burning. Things are getting more expensive. Interest rates are going up. Globalization's being reversed. Countries are necessarily focusing on becoming more self-reliant, or having to focus on the bottom of what we call the pyramid of needs for a nation, the foundational blocks of what you need to have a successful country. Things like national defense, energy security, food security, industrial policy that gives you industrial security. You can't have the sort of top of the pyramid fun stuff without that stuff being intact, those important elements of the foundation. And for too many years, we've almost been mortgaging or deteriorating that foundational level elements, trying and striving even harder to have more of a fun time and to be focused on self-realization, self-actualization, entertainment, dare I say it, personal pronouns, enjoyment, and that now we have to get real. So I think, part of Trump's message, if you will, to other countries is the U.S. isn't going to back you up anymore. The U.S. isn't going to be your provider of security or your provider of energy necessarily. We're going to have to cut a deal. It's going to be a commercial relationship. It's a reminder to other countries where we have to head, which is we're on our own. We can rely on other countries to the extent that we're of like mind for a period of time, but we can't count on it forever.
And this is driving, it sounds like part of that like onshoring story that we do hear a lot about for the US, onshoring, nearshoring. And this is, I'm assuming in your view, one of the underlying reasons that this has become so popular that we've seen there, especially when it comes to, things like energy, utilities, et cetera.
Yeah, and we're just getting reminders like the Iran war, like the grid breaking and failing in Spain, and the warnings that the grid company is putting out in the UK today about tonight. We might have brownouts and blackouts in the UK tonight. These are all just reminders of the fact that every country needs to get its act together and provide for its base level foundational elements of a pyramid of needs.
And so why do you think it is then that investors focus on those big headlines and probably a lot less than what we have just talked about and this pyramid of needs that you're discussing? What is it about the headlines that is just like making it more attractive to make that the story when there's actually this kind of second layer effect that isn't even being discussed?
I I think it's simple. I think it's not that people want a simple story. It's that people want to tell a simple story. And life
Makes their
isn't
job
simple.
easier.
Yeah. Life isn't simple. Trying to maintain or operate something like a nation is extremely complex. The issues around, if you take just a tiny little piece of the issues around net zero and decarbonizing, these are incredibly complex equations that need to be solved, that are based on chemistry and physics and economics and socioeconomic reaction functions. This isn't something that can be explained in a 5-minute soundbite.
Yeah. Well, funny enough, I was going to say AI is a great example. Energy and EVs is certainly another one. But with AI, especially with so many headlines centering around AI, they tend to center around, the software. Companies, NVIDIA, I think everyone probably knows what NVIDIA is, what they do, and who they are. It's so well covered and talked about. Yeah. But there's so many other stories and enablers of AI that get often overlooked. And I think you have some of these underlying companies to this story. So maybe you can just kind of walk us through what is it about the enablers that people are missing, and what do you have in the portfolio there?
Well, I think it does get back to telling a simple and clear story. It also has to do with those whose prime mover is AI. Those are the ones who are talking about AI all the time. The fact is that you can't do AI today or for the next 15, 20 years in many countries without using natural gas to make electricity. But that's a pretty complicated story to tell, and it's not exciting, and it's not a pure AI thing, and it's not something where a natural gas company is going to say, we do AI. Yeah. AI is one of our customers, and it happens to be a customer that's growing really rapidly, but that's just not a news breaking thing for the media. And similarly with semiconductors have been quite popular recently, but for the first 2 or 3 years of AI, there was no association between AI and DRAM or flash memory or high bandwidth memory or Taiwan Semiconductor, the makers of all the bits that go into the thing that NVIDIA sells. It's sort of the fascination with AI stopped at NVIDIA. And it was great for us because it enabled us to build, very large positions in the true enablers, the underlying enablers of AI. And those are big positions that we hold through to today.
And you've talked about previously green inflation. So the idea that the energy transition might be necessary, but could also be structurally inflationary. And how do you actually think about that in practice? I mean, how would you explain that to the listeners? And what does that mean for energy, for markets?
Cutting to the answer, we've seen green inflation or greenflation through the utility bills in every country that's made a priority of pushing alternative energy, wind, solar, and batteries. Those are all power plants, if you will, in quotes, that cost money to deploy. And on a cost per capacity or cost per output basis, they're rather expensive, particularly when you think about the fact that they're intermittent. You can't rely on them. And there are days when you have no wind and the sun goes down or behind a cloud that people still need electricity. So if you have a grid that you're really pushing hard on, say, wind and solar and batteries, and you're paying for that, you then also need to pay for a grid that sits off to the side and isn't being used until it's needed. So effectively, you're building 2 energy grids, 2 electricity grids, when before you only had 1. You have to pay both. You have to pay both the new energy sources and the older, more conventional ones. You have to give them a rate of return such that they continue to operate, or they'll shut down. You're almost making a grid that's twice as expensive, super, super simplistically.
And how or where do you see then the opportunities in that story? Do you have utilities in the fund, for example, or the providers, the grid, perhaps?
I think where we're finding the sweet spots for us, where we can buy very low expectations names, very attractively valued names that we believe maintain a way more important role in the entire grid and the system than the market is giving it credit for right now, is natural gas producers in certain parts of the world, North Sea oil and gas producers for the British North Sea, those who are transporting natural gas around North America. So it's kind of, bits and pieces, no pure utilities. The problem with many utilities is that they're the ones that they sit between the government and the ratepayers. And when the ratepayers are squawking about their bills being too high, and the government is the one that has to approve what the utility is asking for from a rate standpoint, they don't want to make their voting public angry. So they tend to shortchange the utility that's stuck in the middle, has to build another power plant because demand is on the rise because everyone is buying EVs, or their EVs plus AI data centers getting rolled out in the service territory. They have no choice. They're forced to add capacity, but the government doesn't give them a fair return on it. So the utilities can be kind of in the squeezed middle, if you will.
And I mean, stepping back slightly to building the portfolios, as I mentioned at the beginning, you run 2 elite rated, you run the global balanced and the global cautious. How do you go about building both of those portfolios that can kind of endure through different markets and different cycles, whether that is inflation sticking around, whether it's, the AI driven growth or kind of the energy transition, a few of the stories that we've talked about? How do you go about building both of them starting? Is it starting with a blank piece of paper, or how do you approach that?
I mean, you can think about it as starting with a blank piece of paper. I mean, in theory, we buy the portfolio every day. In practice, you obviously can't do that, but that's kind of the mentality that we employ. We're primarily valuation driven. So when something pops up as being where the market's overly pessimistic, we'll go, and if we decide that it's worthy of a spot in the portfolio, we have to find something to kick out of the portfolio, or a few things to shave off other positions to put it in. And that will, over time, that changes the complexion of the portfolio. It changes the portfolio's ability to withstand different risks that may appear. We like to think that we're, constantly maintaining an all-weather portfolio, if you will, that can do well when the sun's shining and the winds are calm, but can withstand the stormy periods that happen upon us. Whether they do or not is outside of our control, but we do, apply risk measures and metrics, and spend a lot of time focused on making sure the portfolio is adequately diversified, that we're not concentrating exposures into any one area, or neglecting any other area that is place that's worthy of investment. So it's just a lot of hard work, a lot of elbow grease, and then after that, it's hoping that the market treats us well, knowing full well that it's not always going to do so.
And in the balanced fund, I noticed that you have quite a meaningful allocation to emerging markets, something like 30%, I think. So what's driving that EM exposure? Is it something that's particularly standing out? Is it just we're trying not to be concentrated in the US? Is it what is happening? Is that all equities? Is it equities and fixed income? What makes up that allocation?
So it's absolutely coming from the bottom up competition for capital. So again, it's that process of a name being attractive to us that we need to find capital for in the portfolio, and it competing well with other ideas in the portfolio. If I'm looking at the big concentrations within the EM, first of all, the biggest concentration will come from Samsung and Taiwan Semiconductor. So are those EM or quasi-EM?
Yeah.
They're certainly in Korea and Taiwan, which are in the EM part of the index. That's a big chunk. Brazil is a big chunk, both on the equity and the fixed income side. It's about 5%, 5-6% of the portfolio overall. And that's split equally between short-dated government bonds, yielding 13-14%, 9% real, and some companies that we find attractive there in the current environment. Also Iceland, got it only in the debt side in Iceland. Iceland's considered in the EM. And we find that the 1, 2, and 3 year notes there yielding 7, 8, 9% is to be quite attractive. And those are, in the EM in general, just to broaden it out, we have positions all spread throughout the EM, including in the Philippines and Colombia, a little bit in Argentina. So we're kind of spread throughout the rest of the world.
Of allocations.
So that's right. Yeah, it's probably one of those EM countries is going to win the World Cup. And overall, though, one of the things that's kind of popping out to us is what we like to call EMs behaving like DMs, like DMs should, developed markets should, and DMs, developed markets, behaving like EMs used to. It struck us that, Brazil is running a much lower deficit than the United States. It has lower debt to GDP than the United States. It has structural barriers to overspending that the U.S. doesn't have. The U.S., on the other hand, is running a wartime level of deficit. It has a debt to GDP of approaching 120%, which is kind of redlining. And we can't see a way of or a political will to unwind that scenario or to recover from that scenario. The U.S. is spending more on interest expense on national debt than on defense. And throughout history, that's a really bad setup. It's a precursor to kind of the fall part of the rise and fall of nations. Brazil doesn't have that problem. So people look at us and, you're running a global moderate risk multi-asset fund, isn't holding positions in Brazil risky. Yeah, but we think we're being compensated for the risk more than adequately.
I was going to ask you about government bonds. I was going to ask you about government bonds in the cautious fund, because I noticed that it's almost about half the portfolio.
Yeah.
I had assumed that was going to be U.S. Treasuries, but given that we've just talked about some EM government bonds, I'm thinking maybe that's not all U.S. Treasuries. So what's happening with the fixed income allocation?
All right, so the cautious fund will have a bigger helping of the positions in Brazil, of the debt positions in Brazil, Iceland, Australia, Norway are the other countries that we have government debt. We do have significant helping of U.S. debt, but it's focused on the short end, and it's focused on the longer end. It owns TIPS, Treasury Inflation Protected Securities, where a 30-year TIP right now in the U.S. is yielding 2.7% real. That means whatever inflation is, you're going to get inflation plus 2.7%. The risk that we're carrying in those, and they're not riskless. The cautious fund is a lower risk fund, not a no risk fund. The risk in the TIPS, there's no inflation risk, but there is duration risk. So if inflation is as high as we think it's going to be in the US, there's a risk that the nominal bonds, the longer dated nominal bonds, will be terrible. They'll go down. There'll be capital losses. They will drag down. That capital loss in the long end will not be ignored by the TIPS. They'll go down to some degree. The cash flows will be fine. If we hold them for 30 years, we'll get inflation plus 2.7%, but we will have a shorter term capital loss. So that limits how much we invest in those longer dated TIPS. The other risk, and this is a bit out there, is that we get 2.7% plus CPI. CPI is a government statistic that the government manipulates, we think. We know. I mean, the government has changed what goes into CPI and the weightings in CPI from the 80s, the early 80s, when the CPI was kind of brought out and was relied on for investments. So there's a risk that the government just keeps defining inflation down, and we're not getting true inflation protection from an inflation protected security. So that's another reason we live at the size.
And then if we just step back for our kind of to wrap things up from individual positions and kind of themes that we're maybe talking about, what do you think that investors are still just underestimating about the short to medium term and what to expect?
I think there's a lot of complacency in the market, particularly in the U.S. market. No one cares about valuation right now. They care about, missing out on the hot IPOs that are coming. They care about missing out on, having exposure to AI. They don't really, even if they don't understand really what AI is, not many people do, or where AI is going to go one day, they want to have exposure to it because it's cool and it's going up. The faith of the world in the U.S. markets and the U.S. large cap tech scene is just incredibly resilient. And they're, willing to buy into the U.S. market and overweight the U.S. market, regardless of the valuation gradient to the rest of the world. That's why our weighting in the U.S. has kind of been dropping over time and going to the EM, because EM is the opposite of the U.S., the most developed market in the world. So that would be my biggest thing. And if it sounds like a complaint, it is.
Well, what a way to finish.
With a complaint.
With a complaint.
Right, great.
Maybe we should finish it with something a little bit more optimistic.
Okay.
What are you most optimistic about? And maybe it is a contrarian view that people don't agree with you, but you personally are really excited about in that short to medium term. Let's end on a high.
Well, so I don't know if this is, as a contrarian, I don't know if this is going to be a positive or a negative. It depends on who's listening. But seeing the formerly kind of blue chip, top of the line growth sectors go down a lot and get cheap and come into our universe. That's a super big positive for us, right?
Yeah, exactly.
It's not a positive for those who held the securities beforehand. But the software, the entire software space has come down into our rangefinder, into our universe. The consumer staples, the luxury goods areas, biotech have all become interesting to us. And that's not just interesting to us and important to us from a opportunity standpoint and us getting more opportunities to look at, but it's indicative of a value cycle. That's typical of a value cycle, that you get rotation, that you get industries and sectors becoming valuable and valued and then getting taken out and shot, and the valuations getting down to levels where value investors can buy them. So, if you just look at the last couple of years, 4 years ago, we bought into the non-US defense sector at 4, 5, 6 times earnings. And we were selling those names at 25, 30 times earnings. We were buying biotechs at, big discounts to book value and our perception of their probable stream of cash flows that can come from success on their drug pipeline. That is a typical value type of rotation or regeneration. And if that means that we're in a value cycle after 14 years post GFC growth cycle, that's a wonderful position for us to be in, and that is our nirvana.
Perfect. We'll end it there.
Okay.
Fantastic, Alec. Thank you very much.
Great.
So interesting as always.
Thank you.
The Orbis Global Balanced Fund is a moderate risk fund designed to be all-weather and suitable for long-term investment. Unlike many funds that are created for specific market conditions, Orbis focuses on a select number of funds that are intended to last in perpetuity. To learn more about the elite-rated Orbis Global Balanced Fund or Orbis Global Cautious Fund, please visit FundCalibre.com.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.